This week I want to speak to you about a couple of things, namely interest rates. So why do they go up? Why do they go down? What are those forces that are causing these changes? And what's the outlook for Australia over the next 12 to 18 months? So I'll jump into the outlook and I suppose my prediction over the next 12 to 18 months. Certainly don't take this as gospel, but I don't actually think we'll see any change. I think probably the earliest that we'll see change in the RBA's cash rate would be the end of next year. So let's say November next year. That's when I'm tipping that we could see the first possible increase. Now, over the sort of medium long term, it's likely that rates are going to increase. And I think possibly by the time we actually get around to kind of this time next year, I might actually be pushing that out a little further. So how about let's go as far to say my prediction is that we won't see an increase in the RBA's cash rate this year, and we won't see one next year. So there's proof, there's evidence, whether it's evidence of me being wrong or right, it's going to be there. So the other thing, the main thing that I really want to talk to you about today is what are the forces that cause interest rates to go up? What are the forces that cause them to go down? So when we think about forces, there's really two majors at play. Most people just think, okay, it's the RBA's cash rate. That's the only thing that affects interest rates. And it's not. And we've really seen this over the last couple of years. So let's talk about market forces and regulatory forces. So the market forces, that primarily is seen in the RBA's cash rate. So their mandate is essentially to keep the inflation rate between a certain band, 2 to 3%, and it's currently very close to the 2%, which is actually putting some pressure downwards on interest rates, although I don't think we'll see them go down probably ever, but certainly not for a little while. I think we'll be pretty steady. Now, so as part of that, so that's I guess the economic or the market force behind interest rates. So I don't think we'll see any change on that front. Now, in terms of regulatory, we may see some changes in that front. So whilst we won't see any changes in the actual cash rate over the next 18 months, I don't believe, we may see some regulatory changes. So essentially what's happening, the regulator is trying to strengthen the banking system, and therefore they're doing things like putting higher capital restrictions on lending, which is in turn essentially makes it legitimately more expensive for banks to lend money. And so we have seen some increases in rates over the last 18 months or so that have come predominantly from regulatory forces that have legitimately put some pressure on interest rates. Now, one thing that a lot of people have been a little bit upset about is investment rates in general. And so part of the reason why is because so a certain regulatory, I guess, expense has been loaded onto these, except a lot of banks or a lot of lenders have then put a little bit extra on top of that. Now, as part of the regulatory restrictions, there's capital restrictions, so they have to have more capital back in the loan, which essentially makes it more expensive for them to lend to you. On top of that, they've had restrictions in terms of how much they can grow their investment lending books, let's say. And so this has caused a bit of a problem for them as to, okay, well, how do we slow down that increase so that we maintain the regulator's limit? Now, one thing they could do is get to the limit and say, okay, no, we're not going to take another client whatsoever. To be honest, that would be kind of silly. And the way that they've done it actually does, from an economic point of view, from my point of view, it makes sense, whilst it is kind of quite annoying in the same vein. They have essentially, or some lenders have chosen to put a little bit extra on top, which then causes less people to actually take out those loans, which then causes them to increase less quickly towards that limit of how much they can grow their investment books. However, what this has also done, it's put this extra cost onto current customers. And so we're seeing a little bit of a bit of an issue, but also a bit of an opportunity for people to then look for better rates elsewhere. Yeah, so that's pretty much everything that I wanted to talk to you guys about today. Hope that's helped. So my prediction is no rate increases for the next 18 months, and hopefully that's explained a little bit of, in very, very basic terms, some of the forces which actually affect rates.